The Palantir stock has been the topic of many conversations, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying more stock. As the current macroeconomic context is still very volatile at the moment, we should be mindful about which positions to pick, as well as their individual timing and exposure. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Palantir had an amazing run in the early July so far, as the stock seems to confirm its willingness to leave the $8 level behind us and to attempt a durable comeback above the $10 level. Whether the market is able to hold that level remains to be seen, to be honest, as the overall economy, along with significant chunks of the market participants, are still skeptical of how well the economy is going to be within the next couple of months and maybe years. Except this time, it's also exactly this lackluster economic outlook which gave the market a renewed perspective about the pertinence of investing in growth stocks, as the federal bonds yield decreased due to the economic growth issues. As the rates decreased, there was a relative increase in the amount of attention and momentum brought to the equities once again, especially for the growth stocks. Ultimately, we should also consider and wonder if Palantir has now become a go-to stock if people think about high-performance tech stocks, as long as the capital flight in the market is aligned with additional purchase timing. So far, it seems like we will see some of that in the future. Of course, we should be careful about too much bullishness in short notice. The VIX number is still almost at a 10-year high, and so far there has yet to be any sign of sustained decrease. This is why we should be disciplined in our approach. Now, let's take a look at the technicals of Palantir. The trading volume of Palantir has recently been 56 million shares versus an average volume of 40 million shares. Over the previous 52-week period, its price fluctuated between $6.44 and $29.29. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of momentum and attention for the stock. It often gives you a first-hand idea about the popularity of the company, and when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, this can be an interesting indication because it may signify that a trend reversal could happen soon. The market cap of Palantir is currently around $16 billion versus an enterprise value of around $26 billion. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for many growth companies may be the intangibles, meaning they're not items or inventory that a company can use, but secondary items to provide growth potentials for the future, such as intellectual property, brands, and schematics. For startups, most of their valuations are based on the intangibles, meaning they can be valued in more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below its book value, but it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place, and it has deflated itself ever since. As we compare the current price to the historical price fluctuations, the stock is 34% higher than the 1-month low, 56% higher than the 3-month low, and 56% higher than 52-week low. On the options market, which usually gives us a hint about the market sentiment, the implied volatility is 70% versus a historical volatility of 76%. The put-call volume ratio is currently at 0.43. It is normal for many stocks to have a higher put option volume than what they truly deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 137,000 contracts a day versus the 30-day average volume of 123,000. In terms of open interest, the most recent volume of open interest has been 2.4 million contracts versus the 30-day average of 2.8 million contracts. The option contracts are derivatives from underlying securities, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract gives you the right, and selling the contract gives you the premiums along with the obligations to execute the contract. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. For example, if there's a lot of put options, there may be possible uptrends on the move, or that there can be a reversal if there's a lot of call options. The reasoning behind that theory is very simple, and it is that most options would expire worthless eventually. In terms of shareholder structure, institutional shareholders own about 31% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and State Street. It is relevant to understand the shareholder composition of a company, as this can help us to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, that can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions to this since many great companies are also mostly held by retail traders, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit should the stock price fall lower. Sometimes there is significant short interest in the total volume, and that can be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is about 6% of the total float, with about 48% of those transactions coming out from the dark pools or outside the public exchanges. Usually, if the short interest is above 15% of the total volume, with a significant chunk of those short volumes coming out from the dark pools, this could suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is to buy Palantir and to dollar average down over the next 12 to 18 months by writing out any potential negative outcome in the upcoming period. I would recommend to commit between 5 to 8% of your portfolio and to split the allocation in batches of 20% at a time so that you could purchase more if it keeps retracing. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.